reserved for. That role in itself, although I think a lot of it can depend on exactly where you end up, what type of auditing you do, but it's a very, very important role. So, management, board, investors, shareholders, everyone places a massive reliance on auditors.
Yes.
And then essentially playing that additional line of review role external to the company. Because obviously a company has people who do first line and second line.
Yes, so that internal audit,
exactly.
right?
Yeah. So you've got internal audit. Even nowadays, you've got the head of actuarial function, which is a bit of a second line role. So you're doing a lot of review and kind of internal checking and reviewing of results. But that's still not enough. The complexity that we deal with and the level of judgment that's often needed on a lot of the items that we work on, having that external view and opinion can be invaluable. So that's where the audit side of it then comes in. Is you essentially going in and reviewing, checking, challenging certain ways that calculations have been done, certain ways that reserves have been set. The capital requirements, are they sufficient? So it's those two different legs. It's seeing a very similar type of work, but with two different lenses.
I think just to sort of double click on the auditing, why is it that an actuary needs to be involved in that space? I think, what students sometimes say to me is, well, why can't a CA just do that? Why can't a CA just check a reserve? And I think, given that you've worked in that space, it's maybe obvious, but it's not obvious to someone who hasn't been exposed to that.
So that is very important. But when I say audit, it's not kind of counting chickens and doing stock takes. It's not that. There's certain professions who sort that out. This is auditing of the financial calculation. So saying, okay, yes, there's a reserve that's been calculated. Why does it need an actuary? Because actuaries are one of the only people who can actually understand that kind of 30, 40, 50-year time horizon, the projection involved, the assumptions that are going into it in terms of your mortality, interest rates, expenses.
Whatever the risk, underlying risk is.
Whatever the underlying thing is that is being calculated, with all due respect, and people who haven't studied, who haven't got that kind of actuarial degree and the underpin of that, just aren't in a position to challenge that sufficiently. They can always, they can check the numbers and the numbers reconcile between different things, but in terms of actually essentially independently performing that calculation, you need an actuary. If it took the actuary to do the calculation in the first place, it takes an actuary to independently check it and potentially even independently reproduce it. I just think a lot of it is down to the fact that it is a multi-year projection or time horizon that you're dealing with. A lot of other professions don't get exposed to that early on. They will ultimately, kind of as they get more senior and as you start getting...
where you have to make strategic decisions.
Exactly, you have to make strategic decisions, but kind of as an actuary, you're taught that from day one. I mean, the very first thing that you know is present valuing of cash flows, and those cash flows are...
Discounted cash flow model, 100%.
So that's first year lecture type stuff. So...
And then just talk to the relationship when you are auditing. So obviously there's CAs that will be a big part of that auditing process, regardless of whether it's an insurer or not. And then actuaries will also be involved where there is actuarial functions that need to be verified. How do the two play together?
Not always nicely, to be honest. It's just a treat. And I mean, actually now with IFRS 17, it's become particularly challenging. So IFRS 17 is essentially, it's a new accounting standard. I know why it's called an accounting standard, but it's hardly an accounting standard. It's essentially the way that insurers need to produce their financial results and report on them. Globally, that's very important. So every insurer around the world has to do the calculations as set out in the standard. Now, it's an accounting standard because it goes hand in hand with other accounting standards that exist for other companies which maybe aren't insurers. The reality is that it needs actuaries to do the calculation to be involved with it. But there's actually a much stronger link between the two now. So in kind of prior to IFRS 17, to be honest with you, what would happen is if you look at a company's balance sheet or even their income statement, 90% of that in terms of line items was accountants' things to worry about. Okay, go and verify, that deferred tax asset, go and verify that bank account balance, all that, stuff which was... So if you look at it, let's say there's 30 items on a balance sheet in terms of line items, 28 of them accountants could sort out. The problem is that those line items probably only account for 10 to 15% of the company, because if you're an insurer, your biggest liability on your balance sheet is your insurance liability, the actuarial reserve. So in the old order was one line item. It was 80-90% of the insurer's balance sheet. I mean, that's
from a materiality perspective.
From a materiality perspective, it's kind of where all of the where all of the difficulties and challenges lie. So it was a lot easier, in my opinion, in prior to IFRS17 because it was very demarcated. You worry about that.
I'll worry
about this. Kind of, let's all get together and we'll come together and sign in totality at the end. The sheer way that, and I think it's a sheer good thing, the way that IFRS17 and the financial reporting and just the general management of companies is starting to unfold, is that the actuaries and accountants have to work much, much closely together.
Yeah, so more multidisciplinary.
Exactly. It's way more multidisciplinary. I mean, everyone jokes with me that I've kind of got an honorary accounting degree. I've done a couple of debits and credits over the last couple of years. But, ironically, that's fine because I could have ended up there initially. So, I mean, to give you an idea, the fact that I actually am doing debits and credits and trying to understand things, it tells you that where to move. There's not just the one line item, and there's a lot that went into that.
Yeah.
That one line item in terms of a company's financials is blown up and it's disclosed in lots of different ways.
Yes.
And just the interdependency between that and actually stuff that accountants would
other cash flows
and other cash flows has imploded. Or exploded, rather.
Maybe imploded on occasion.
Yeah. That's just so true. And actually, I think so that has, at least for now, there's not. These two professions aren't actually that used to working that interdependent with one another.
Yes, and also understanding what the other one does necessarily.
Precisely. So, it actually has caused some frictions. And actually, I thought you guys were checking this, or why don't we both check that? Because it is. I think actually everyone's still finding their feet a little bit on that front.
Yes.
But at the same time, I think it's positive. I think different professions bring different skill sets. It's probably statement. And I think, although I'm not currently on the kind of audit side of it, I've obviously been very exposed because we have to be audited.
Yes.
You can see that everyone's still figuring it out a little bit. So there actually are times where it's like, oh, okay, you guys are looking at this. I would have thought that the accountants should look at people. And I think just as it matures, I mean, so IFRS17 literally came into effect this year.
Okay.
So as it matures, as it unfolds, those, just those lines of responsibility will become a little bit clearer. But I think ultimately, the two professionals are still going to have to work a lot more closely now they're going forward.
Yeah, and just to talk to IFRS17, why the change in regulation and sort of that standardization across the world, and also what were the key changes that it introduced? I realize that's a massive question, considering that it's multi-page piece of regulation and documentation that comes along with it. Yeah. But how would you kind of frame that for a listener?
Cool. No, don't worry about it being multi-pages. If you can't explain something so clear, then you don't understand what it is.
Say like a true lecturer.
So if we, and this is actually, I mean, I was very, very young. Yeah, you have to go back to the early 2000s. And in fact, let me take another step back. If you're an analyst or a shareholder of any company other than an insurer, okay, you can take, for example, the financials of MTN, being a telecommunications company, and the financials of Anglo, being a mining company.
So nothing in common.
Nothing in common, okay? Apart from the fact that they both have shareholders and, look to make profits. They're completely different industries. And you can look at those financials and you can compare those financials because they have the same underlying principles in terms of how they're derived, how people, although they're different in nature, how they need to disclose things. What is it? What does revenue mean? What does revenue as a concept mean? It's got the same underlying principles because both of those have, I can't actually remember, I don't know since when, have been governed by a common IFRS, International Financial Reporting Standard, on a global scale. So not even MTN in South Africa, Anglo, you could compare MTN to, let's say, Vodacom in the UK, or Vodafone rather. So on an international scale, companies which weren't insurers for a long time have actually had the similar underpin in terms of the principles of how they need to go and produce reports to their results. And therefore, from a comparability perspective, that's been great for analysts and shareholders.
It's just more accessible, right? So you're not constantly trying to have to standardize different metrics to see, is this company actually outperforming this company? Instead of saying, okay, well, they're reporting on exactly the same basis.
Exactly. So in the early 2000s, I was young, very young. The ISD, which is the International Accounting Standards Board, had a go at producing this international reporting standard for insurance companies. This was in the early 2000s. And what they quickly realized is, this is complex. This is going to take time. And therefore, what they actually introduced was something called It was actually IFRS 4 phase 1. They even called it phase 1 because they knew that this was not the end. It was just, this was complex, and there was obviously a bunch of other things to sort out. So one of the big things, at that stage was like the dot-com crisis. And
of course, early 2000s.
Exactly, 2000s. And then even then, they tried to have another go at producing an international financial reporting standard around 2007. There was a global financial crisis.
Yes, yeah.
And the global financial crisis had a big banking issue, and that's what IFRS 9 was a key focus after that. So IFRS 9, which is like the equivalent of IFRS 17 for the banks, that got a focus coming out of the global financial crisis.
Yeah.
So it was one of those where they kind of put a pause on trying to do something like this, but it's just there's always been these stumbling blocks.
Yeah.
But the problem is that back then, essentially what they said was, okay, they called it International Financial Reporting Standard, but it was not an International Financial Reporting Standard. What it basically said was, okay, go and do what your local authorities or local regulators want you to do.
Yeah.
And that's why then what ended up happening is, okay, that's fine. In South Africa, through the Electoral Society of a whole bunch of guidance notes, we develop ways and practices, and we'll do the calculations. As companies in South Africa, even within that, there still is discretion, but there used to be much more discretion around your reserving and what level of margins should you put in. And there's an inverse relationship between the level of your reserves and your profitability.
Yes.
So
because it's where your money's sitting.
Exactly. So even in South Africa, there was quite a lot of discrepancy, although there was similar principles and frameworks.
The interpretation
thereof. It was, all of it was interpreted in line with the guidelines, but there was a lot of kind of power in the actuaries' hands in terms of what level of reserves should or shouldn't be set up. And that was just in a South African context. They don't mind the fact that I always use this example. It's a bit of a silly example, but I think it always puts it into perspective. Some companies overseas, like you don't have to discount the cash flows, as an example. So in South Africa, we discount the cash flows.
Yes.
Because the International Financial Reporting Body said, look, go and use what your local regulators require you to do. Mm-hmm. Those local regulators said, you know what, you're not required to go and discount your cash flows, which sounds absurd.
And it does sound.
But if you take a step back, if you're in a relatively low interest rate environment, and if you don't discount your cash flows, you actually are being...
It's prudent, actually. Yeah, because when you discount, you're obviously stripping out that.
Exactly. And most of the time it'll be more prudent to discount. So what they said is, you know what, actually, if you're talking about from a reserving, we don't want you to discount, or you aren't required to discount. And it's quite silly, but now you've got even on something so simple, you've got insurers around the globe who are just following completely different principles around one's discounting, the other one's not. And for an analyst or shareholder to go and unpack that, and to your point, go and standardize for it is virtually impossible.
Yeah.
And look, and that's why that's why there were some other frameworks of standardizations that tried to kind of come about. Basically, then in around 2013, so once they were done with IFRS 9, that sorted that out and just got the other financial institutions to report on things a bit better from what they'd learned from the 2008 financial crisis. They then shifted their focus to insurers.
Yeah.
The scary thing is this started in 2013.
Sure.
And it actually took from 2013 to 2017 for them even to release the first version.
Iteration.
That's 4 years. It only the initial date when they wanted, so from then 2017 till 2019 was constant iteration, because you're trying to get the whole world. You're trying to get not every single insurer, because it doesn't work like that. Obviously, you've got country representation, but you're essentially trying to get the whole world to agree on an accounting standard. Yes. That's complex. So it still took about 2-3 years after that. Input, they had like resource groups, transition resource groups, where people could give their feedback. And then effectively around, I think it was around 2019, that was when kind of the final version of the standard landed.
Sure.
2019, 2020, somewhere around there. COVID's a bit of a blur for most of us.
I hear you.
And then, the effective date of the standard was only now, 1 Jan 2023, sure. Which is actually 10 years.
Yeah, it is.
From when they started. I was in honours in 2013, completely unknown to me what was happening in the background.
Yeah.
But I think, it just speaks to the complexity of insurers and just, the complexity of what you're dealing with.
And of risk.
And of risk in general, and how to account for that risk, obviously to reserve sufficiently, but also to record profit.
Yes.
In line with the service that you're providing.
Yes. And with transparency.
Exactly. And with transparency. And that someone else can understand and compare.
Compare.
different companies. And the nice thing now, at least, as the time goes on, we are now part, again, an analyst or shareholder will be able to look at